the Dow Jones, and on Friday night US equities fell. In particular, the Dow Jones fell 665 points. The way that investors should be thinking about the market at the moment is to draw a resistance line along the top there at 26,616 in the Dow, and you really need to be thinking about how you protect equity portfolios as long as the Dow trades below that high. One of the ways that we're recommending investors do this is through the BBUS, which is a short ETF on US equity. So meaning when the US equity markets fall, the value of this ETF actually rises. And you can see there, just over the past 3 or 4 sessions, the BBUS has traded from $4.55 up to $5.10. And the way to manage the risk in this instrument is to run a stop loss back below that 455 low. So I'll just bring into screen the fact sheet on the ETF so you can see a little more detail on how it works. So the provider of this ETF is BetaShares, and just looking at the summary of the fact sheet here, we can see here the fund's exposure to movements in the US share market can be expected to vary from 200 to 275% short on a given day. Therefore, a 1% fall in the US share market can generally be expected to deliver 2 to 2.75% increase in the value of the fund. Now, we can buy this on the ASX like we would do a normal share. And if you'd like to know more about protecting your equity portfolio and using hedging instruments such as BBUS, please call our office on 1300 614 002. Looking at a couple of other points of interest in the market, so that was the hedge on the US equity market, which I think value for money is the best way to protect a portfolio. The other alternative is the BBOS, which is the short XJO position that works in similar way to the BBUS. But I think given the excessive overvalueness or overvalue PE ratios that we've been warning about for some time in US equities, arguably the BBUS is the best instrument to quickly hedge a portfolio. And I think the key with it is to think about it purely from the point of view that it's protection as long as the market stays. I'll jump back to that graph of the Dow again. So as long as the Dow stays below that high, you want to have some hedging in place. You want to be thinking about stop losses on individual equities. You want to be thinking about where you can trim high PE ratio names from your portfolio, maybe trim cyclical names, resources, banks, and just start to build a more defensive position in your portfolio. Try to free up cash where possible. And if the market is actually a shallow sell-off like the others have been in the past, you're only going to give up 2 or 3% to then reset those long positions back up. But the chance that this sell-off has more momentum than those that we've seen in the past, you want to be looking at ways to protect your portfolio early in the piece, not when the market's down 10 or 15%. Looking at the ASX 50 this morning, it's always interesting just take note of which stocks are holding up best in a market that's been heavily sold. And when we look at that, I think you can see Sonic Healthcare is holding up okay, AGL, Aristocrat Leisure. So out of all the high PE names in the top 50, Aristocrat's probably holding up the best. Woolworths, which I think is just reflective of what I spoke about last week, where the market's recognising that Woolworths is winning market share off Coles. CSL continues to do well, as it did even throughout the GFC, so it's a very defensive business in vaccines, in blood plasma. And ASX, a bit of a beneficiary of a pickup in market volatility with added transaction flow. The other one that I thought just worth highlighting that's holding up okay today is Amcor, so fairly defensive in packaging for food and tobacco. So there are a couple of names. If you're trying to run long positions in portfolios, strip out the upcoming dividends, sell tight covered calls. So it's not a matter of getting out of the market entirely. I think it's just trying to keep in these low volatility names and put a hedge in place using that BBUS. So again, I encourage you to call our office and have a chat about what we can do through either buying put options to protect your portfolio or using these ETFs, inverse ETFs, to profit from a down move in the market, which will act as a hedge against your other shareholdings. Thank you for listening in.